Two people sat in the exact same personal finance class when they were 22 years old. They listened to the same instructor. They received the same worksheets. They heard the same explanation of investing, retirement accounts, and compounding. Both walked out believing they understood how money grows over time. 40 years later, their lives barely resemble each other. The first person retired at 57. Their investment portfolio now produces more monthly income than their final paycheck ever did. They wake up without an alarm. Their home is paid for. Market downturns no longer frighten them because they own assets instead of chasing paychecks. The second person is 62 and still working. Retirement has become a moving target. Every unexpected expense feels like a setback. They wonder why decades of hard work never translated into financial security. The strange part is, they don't think they made dramatically different decisions. They simply believe life became expensive. But life wasn't the biggest difference. Behavior was. Research has repeatedly shown that while the broad stock market has historically produced returns around 8.2% annually over long periods, the average investor captures only about 4.3%. That gap isn't caused by intelligence. It isn't caused by income. It isn't caused by secret investment opportunities. It's created by ordinary behaviors repeated over decades. Buying after excitement, selling during fear, waiting for perfect timing, starting tomorrow instead of today. Compounding never punishes ignorance as much as it punishes inconsistency. Hey, I'm Brian, and I spend way too much time thinking about why ordinary people work hard for 40 years, yet still struggle to build lasting wealth. The answer almost never comes down to complicated investments. It comes down to simple behaviors repeated long enough for compounding to either become your greatest advantage or your greatest regret. Today, we're breaking down the 40 laws of compounding. Some take only seconds to understand. Most take years to appreciate. By the end, you'll know which laws quietly double your money and which habits silently prevent it from ever happening. And if you're someone who enjoys practical financial thinking without the hype, consider subscribing. Now let's begin with the first law. If you're new here and just subscribed, comment your name below. I read every comment and shout out new subscribers in my next video. I do appreciate you joining me on this finance journey. Law number 1. Time is the multiplier you cannot replace. If you invest $10,000 at an annual return of 8%, it becomes roughly $21,600 in about 10 years. Leave it invested for 30 years instead, and it grows to more than $100,000 without adding another dollar. Most people believe they need larger investments when they actually need more years. They delay because the first few years appear slow, forgetting that compounding accelerates near the end, not the beginning. The greatest financial advantage is rarely earning more. It is giving time permission to work. Law number 2. Consistency beats intensity. Imagine investing $500 every month for 30 years instead of investing $12,000 only when you feel confident about the market. At 8% annually, those steady monthly contributions build a portfolio worth hundreds of thousands of dollars because every contribution starts its own compounding journey. People violate this law because consistency feels ordinary, while dramatic decisions feel productive. Your wealth is usually built by boring habits, not exciting moments. Compounding rewards rhythm more than brilliance. Law number 3. Your first dollar works longer than your last. A single $1,000 investment made at age 25 has 40 years to compound before age 65. The same $1,000 invested at 55 has only 10 years. Even if both earn the exact same annual return, the earlier dollar accomplishes far more work. Most people focus on how much they invest and ignore when they invest. Every delayed year quietly reduces the future workforce of your money. Early action is a decision that compounds forever. Law number 4. Reinvest everything you can. Suppose an investment produces $1,000 in dividends during the year. Spend that income every year, and your portfolio grows more slowly. Reinvest those dividends for 30 years, and those payments begin producing their own returns, creating a second layer of compounding. People often interrupt this cycle because early gains feel like rewards to consume instead of capital to multiply. The strongest portfolios treat income as additional workers, not spending money. Wealth grows fastest when your gains stay employed. Law number 5. Fees compound against you. Many investors obsess over finding one extra percentage point of return while ignoring 1 percentage point in annual fees. Invest $100,000 for 30 years at 8% before fees, and the ending balance looks dramatically different if 1% disappears every year. That seemingly small fee can cost well over $100,000 in lost wealth, because every dollar paid today also loses decades of future growth. Most people underestimate small percentages because they think in single years instead of compounded decades. Compounding works for costs just as faithfully as it works for investments. Law number 6. Emotion is the largest hidden expense. Picture two investors beginning with the same $50,000. One remains invested during a market decline. The other sells after a 20% drop and waits until prices recover before returning. Missing only a handful of the market's strongest recovery days can reduce lifetime returns dramatically. Fear always feels temporary, but its financial consequences can become permanent. The disciplined investor is not the one who never feels fear. It is the one who refuses to let fear interrupt compounding. Law number 7. Automation defeats motivation. Set an automatic investment of $300 every payday, and your money begins moving before emotions have a chance to interfere. After 25 years, that simple system can produce a portfolio many times larger than someone who invests only when they remember. Most people trust willpower, even though willpower fluctuates every week. Systems outperform intentions because systems never negotiate. Compounding prefers automation over inspiration. Law number 8. Increase contributions before lifestyle. Imagine receiving a $5,000 annual raise. Increase your monthly investment by $300 before upgrading your car or apartment, and every future raise begins building wealth instead of expenses. Lifestyle inflation feels harmless because every increase appears affordable in isolation. Decades later, it becomes the reason retirement remains out of reach. Every raise should first strengthen your future before expanding your present. Law number 9. Market declines accelerate future growth. A broad market index falls 25%. Many investors panic. The disciplined investor continues buying exactly as before. Those contributions purchase more shares while prices are lower, positioning the portfolio for stronger gains during recovery. Most people see falling prices as danger instead of discounted ownership. Compounding rewards the buyer who remains calm when everyone else becomes emotional. Lower prices are often future returns arriving early. Law number 10. Patience has an annual return. An investor checking their portfolio every hour experiences every fluctuation as a crisis. Another checks quarterly while continuing regular investments. Both own identical assets, yet only one is tempted into costly decisions. Research consistently shows frequent trading reduces long-term performance for many investors because activity replaces discipline. Patience is not passive. It is profitable restraint. Compounding belongs to those who can leave good decisions alone. Law number 11. Debt compounds faster than excuses. Carry $10,000 of credit card debt at 20% annual interest, and the mathematics work against you every single day. At the same time, your investments struggle to outpace that guaranteed cost. Many people invest aggressively while carrying expensive debt because investing feels optimistic. Eliminating high-interest debt often produces the equivalent of earning a strong, predictable return without market risk. Before compounding can build wealth, it must stop destroying it. Law number 12. Comparison interrupts compounding. Someone else buys a luxury vehicle. Someone else posts investment gains. Someone else appears wealthier. Comparison encourages unnecessary spending and reckless investing because you begin chasing appearances instead of progress. Your portfolio has no idea what your neighbors own. It only responds to the choices you repeat. If this idea is helping you see compounding differently, take a second to like the video. It tells me these practical conversations are worth making more often. Law number 13. The goal is ownership, not prediction. No one consistently predicts every market top and bottom. Yet patient investors who continue owning productive businesses over decades repeatedly benefit from long-term economic growth. Most people search for certainty before acting, but certainty rarely arrives until after opportunities have passed. Ownership compounds while prediction usually distracts. Your future depends less on forecasting tomorrow than remaining invested for the next 30 years. Now comes the behavioral architecture. These next laws are shorter, but they form the framework that allows every previous law to work for decades instead of months. Law number 14. Compound your skills before you compound your income. A skill that increases your annual earnings by $5,000 creates decades of additional investing power. Your career can become the engine that feeds your portfolio. Law number 15. Know your freedom number. If your annual expenses are $60,000, a portfolio of roughly $1,500,000 supports a 4% withdrawal rate. A clear destination produces better decisions than vague hopes. Law number 16. Protect your downside. One uninsured disaster can erase years of compounding. Insurance is not an investment return. It is protection for future returns. Law number 17. Never confuse luck with strategy. One profitable investment does not validate reckless behavior. Repeatable processes outlast fortunate outcomes. Law number 18. Measure your net worth, not your purchases. A new possession loses value. Productive assets create future value. Track the number that compounds. Law number 19. Celebrate deposits more than market highs. You control contributions. You never control tomorrow's prices. Reward the behavior you can repeat. Law number 20. Ignore financial entertainment. Daily predictions rarely improve long-term returns. Most headlines disappear within weeks. Your investment horizon should outlive the news cycle. Law number 21. Increase investing before increasing spending. Every additional $100 invested monthly compounds for decades. Every additional expense usually compounds into obligation. Law number 22. Simpler plans survive longer. The investor with 3 diversified investments often outperforms the investor managing 30 complicated ideas, because simple systems are easier to maintain. Law number 23. Review without reacting. Schedule financial reviews every 3 or 6 months. Decisions made on a calendar are usually better than decisions made during panic. Law number 24. Teach your family the principles. Financial literacy compounds across generations. One conversation today may influence 40 years of future decisions. Law number 25. Protect your identity from your portfolio. Your investments are tools, not your personality. When your self-worth depends on market performance, discipline becomes much harder to maintain. Law number 26. Your savings rate matters before your investment return. Increasing the percentage of your income that you invest from 10% to 20% often changes your future more than chasing an extra 1% of annual performance. You cannot compound money that never gets invested. Law number 27. Protect your earning power. Your income is the source that feeds every future investment contribution. Learning new skills, maintaining your health, and remaining employable are all forms of compounding, even if they never appear on a brokerage statement. Law number 28. Separate investing from entertainment. Investing should feel predictable. If every decision gives you an adrenaline rush, you are probably speculating instead of compounding. Excitement usually has an expensive price tag. Law number 29. Do not mistake activity for progress. Buying and selling every week creates the feeling of control, while quietly reducing long-term returns through taxes, fees, and emotional mistakes. Compounding asks for patience, not constant movement. Law number 30. Measure decades instead of days. A one-day decline of 3% becomes almost invisible on a 30-year chart. The longer your time horizon becomes, the smaller today's volatility appears. Now we arrive at the advanced architecture. These final laws are short because, by now, the pattern should be clear. Law number 31. Buy more when fear discounts quality assets. Law number 32. Rebalance your portfolio with discipline, not emotion. Law number 33. Eliminate high-interest debt before searching for extraordinary investment returns. Law number 34. Keep an emergency fund so temporary problems never force permanent financial mistakes. Law number 35. Lifestyle inflation compounds just as reliably as investment returns. Choose carefully which one you feed. Law number 36. Ignore forecasts that require perfect timing. Own productive assets instead. Law number 37. Every percentage point saved today purchases decades of future freedom. Law number 38. Your greatest investment is often the habit you repeat automatically every month. Law number 39. Teach compounding to the next generation before you leave them money. Knowledge compounds longer than inheritance. Law number 40. Remember that compounding is never dramatic in the beginning. It is almost always obvious in the end. Practical steps. This week, identify the one law you violate most often. Write it down. Then describe the exact behavior that causes you to break it. You cannot improve a pattern you refuse to measure. This month, automate every investment contribution you reasonably can. Whether it is $200 or $2,000, Remove the decision from your future self and let the system do the work. Today, calculate your actual investment costs. Add together every management fee, fund expense, and advisory charge. Then estimate what 1% of your portfolio would become over the next 30 years if it had remained invested instead. Starting now, write down your freedom number. Calculate your annual living expenses, then divide that number by 4%. Stop chasing an abstract idea called wealth. Start building toward a specific destination that compounding can actually reach. Think back to those two 22-year-olds sitting in the same classroom. Neither had better information. Neither had a crystal ball. Neither knew exactly what the market would do over the next 40 years. One simply followed these laws often enough for compounding to finish its work. The other interrupted the process again and again until decades disappeared. That is the quiet truth about wealth. It is rarely built by extraordinary intelligence. It is rarely built by extraordinary income. More often, it is built by ordinary decisions repeated long enough that time begins doing more work than you do. These 40 laws are simple. They are available to anyone willing to practice them consistently. The sooner you apply them, the longer compounding has to reward you. If this gave you something real, consider subscribing. Every week we break down practical financial ideas that help you make better long-term decisions without the noise. I'm Brian. I'll see you in the next one.